If you had invested $5,000 in Apple back in 2017, which is only 5 years ago, that would be worth $30,000 by the end of 2021. That's a 500% return or a 5x return on your money invested. Compared to if you had invested that same $5,000 in the S&P 500, that would only be worth an additional 100%. Question is Apple still worth the investment today? In this video, I'm going to talk about whether you should be investing your hard-earned money in Apple today or not. I'm also going to talk about two other stocks that should be on your radar, whether you're building a portfolio from scratch or you are an experienced investor looking to add to your holdings. So far year to date in 2022, Apple has not seen the same historic returns. That may actually be a good thing for investors. The best time to buy a good value stock is when there is a sale on its valuation, as long as the fundamentals of the business are still there. This is a famed approach best taken on by Warren Buffett, and he's done pretty well for himself taking that approach. To me, Apple is still well positioned to deliver outstanding stock market returns over the long run, and here's why. First, the company is leading the fast-growing 5G smartphone market. According to Strategy Analytics, Apple accounted for 31% of all 5G smartphone shipments in 2021. Apple's 5G smartphone shipments last year alone exceeded the combined total of the next two biggest vendors in this space. There is a very lucrative opportunity for Apple here. If it can add an entry-level 5G smartphone to its product lineup, it can further boost its shipments of iPhones next year. And according to sources, Apple may even launch a version of a self-driving car as soon as 2025. And this new segment for Apple can be a catalyst to double on its revenue by entering into the automotive space. The company's services business is also growing at a much faster pace than its product business. The services business generated $19.5 billion worth of revenue in just the first quarter of 2022. That's an amazing 24% increase year over year. Apple still has plenty of growth options, and that includes its iPhone lineup of iPhone 13. Just take a look at any Apple store you may drive by or walk by, it's always packed. There's still so much robust demand for its product, especially iPhone 13. And most recently, Apple is actually looking to change up its profitability from the iPhone lineup by introducing a subscription service for iPhone. And according to many industry experts, Apple is expected to release a virtual reality headset either in 2022 or early 2023. Even though some analysts may write off Apple saying that the iPhone has already peaked and there's a lack of future growth, but I would disagree. Not because of the iPhone, because Apple still has many options. Whether it's a self-driving car, mixed reality headsets, or the next iteration of iPhones through a subscription service, Apple still has plenty of options for the next generation of growth. Just in the last 5 years alone, the stock has gone up from $35 a share to $170 per share. This growth already includes stock splits and an ever-growing stream of dividends. In the last 1 year alone, Apple delivered a return of 44% to investors versus the US market at only 6.3%. As you can see, Apple is far outpacing the average US market return all on its own. As it sits right now, Apple is 11% undervalued when you compare the current stock price to its fair value. So is there a buying opportunity for Apple? Based on what we just talked about, do you think the catalysts for growth are there? Let me know in the comments. And whether you're new to the channel or you've seen my content before, do me another huge favor. Hit that like, subscribe, or thanks button because it lets me know to produce more content like this and you don't miss out on future stock picks. You may be familiar with the term dividend aristocrats, which are a group of stocks that have increased their dividends for 25 consecutive years. There is another group above the dividend aristocrats known as the dividend kings. This lucrative group of companies have increased their dividends for a consecutive 50 years. Companies in this category have a proven track record of running a very fruitful and profitable business, while also rewarding shareholders with consistent dividends. Johnson & Johnson is a healthcare giant dominating this category through their multiple business segments such as consumer health, medical devices, and pharmaceuticals. Many of its products and drugs have captured global markets because this giant is known for building well-known brand names. The company recently announced that it plans to spin off its consumer service business, which will operate as a separate public entity by November of 2023. The intention behind the spin-off is so that J&J can focus more on the healthcare and medical devices segments. In 2021, the company saw its sales jump 14% year over year to $94 billion and adjusted net earnings grow 22% to $26 billion. The company's portfolio of drugs under its pharmaceutical segments alone brought in $52 billion worth of revenue in just 2021. Among the thousands of publicly traded companies in the US, there's only two stocks that have been given the most coveted credit rating of AAA by S&P, and one of those stocks is J&J. That means that the global credit rating agency has the utmost confidence in J&J to repay its debt. Fun fact, J&J actually has a higher credit rating than the US federal government does on repaying its debt. Because we can't control when we'll get sick or what type of illness will develop tomorrow. There will always be consistent demand for prescription drug, medical devices, and other healthcare products and services. And this is a space where J&J dominates and makes a boatload of money. Johnson & Johnson's biggest strength is its diversified business model that we all rely on in the healthcare space. J&J also started introducing price increases all across its consumer portfolio in 2022 because of inflationary pressures causing higher input costs. These price increases will help J&J remain competitive amongst other players throughout 2022 and beyond. Importantly, J&J's single-shot COVID vaccine has become a strong contributor to its top-line revenues. The vaccine was approved for emergency and conditional use in some countries in 2021, and vaccinations, as you know, are in full swing everywhere around the world. Just the COVID-19 vaccine alone generated $2.4 billion worth of sales in 2021. So why should you invest in J&J at this point? Well, here's the rundown. It's trading at 39% below the estimate of its fair value. Earnings are forecast to grow at 7.16% per year, and earnings grew by 41% over the past year, and it pays a reliable dividend of 2.4%. In terms of volatility, J&J is less volatile compared to 75% of the US stocks in just the last 3 months. And speaking of volatility, I want to keep making YouTube videos, and hopefully financial literacy spreads everywhere so you, the investor, the saver, the budgeter, can make the right decisions for your family's finances. If you want to help me create even more videos, you can sign up for a channel membership. It's less than $5 a month. You'll get access to photos and status updates, behind the scenes information, early access to new videos, member shoutouts, and priority reply to all comments, DMs, and emails. Each video takes the time to do the research put together to bring you value-added content. Please do me a favor, consider the membership option. It means so much having your support. Link in the description. Stocks that pay dividends and raise their dividends for decades on end can only reach that point if they produce products and services that are in high demand. Steadily growing dividends require companies to grow their sales and their profits, and Coca-Cola is one of those names. Coca-Cola posted double-digit revenue growth as well as adjusted EPS in 2021. The company reported $38.7 billion of net revenue in 2021, which represents a 17% growth rate over just a year ago. And its net revenue in 2021 was up 4% compared to the pre-pandemic era in 2019. The company has a portfolio of approximately 200 leading brands worldwide, and one of the most famous brands of all is Coca-Cola. But the portfolio also includes some other brand names such as Powerade, Dasani, and Minute Maid. These products are sold in over 200 countries and territories worldwide. And think about this for a moment. The company's brand names are heavily embedded in people's daily lives, which give Coca-Cola tremendous pricing power. And as a result of this pricing power, by increasing prices for some of its products, that alone contributed 6% growth to its bottom line in 2021. Let's conceptualize that for a moment. Think of all the cans of Coke that are sold worldwide. If the price of that can of Coke goes up by just 1 cent, that has a huge impact on the company's bottom line because of the volume of Coke that gets consumed worldwide. I'm just talking about one product. Think of the 200 brand names it owns. And because of its top-notch beverage portfolio, analysts are expecting the compound growth of its portfolio to be at 7% annualized for at least the next 5 years. The outlook growth for Coca-Cola is still strong for the foreseeable future. Along with a reasonable dividend payout ratio, the dividend yield of 2.9% is still safe, considering the payout ratio is around 72%. This payout ratio allows Coca-Cola to retain enough capital to pay down its debt and money left over for acquisitions to help grow its revenues and profits even further. When you're investing in dividend stocks, you want to pay close attention to the payout ratio. You don't want the full payout or 100% of the payout going to shareholders, because that means the company doesn't retain enough capital to grow the business. You want the company to grow its operations so it can pay you a growing dividend. That's why for a lot of companies, the payout ratio is a very fine balancing act. Even as the company announced that it will suspend operations in Russia, this is not expected to have a major cutback on its earnings. And that's because management estimates that Russia and Ukraine only account for 1 to 2% of its top-line revenue. So why invest in Coca-Cola? Here's the breakdown. Trading at 12.3% below its estimated fair value, earnings are forecast to grow at 5% per year. And in the last year, the earnings have gone up by 26%, and it pays a reliable dividend of 2.9%. So there you have it, 3 fantastic growing companies, Apple, Johnson & Johnson, and Coca-Cola. Apple appreciation? Check. Dividends? Check. That's what you want to look at as an investor. Are the fundamentals there for foreseeable future growth? Thank you so much for watching. Make sure to check out all the links in the description below to support the content, and I'll talk to you in the comments section.